And our featured guest is Rebecca Patterson, the managing director at JPMorgan Private Bank. And Rebecca, let's start with you. Let's talk a little bit about the trade and the things that you track. You follow dollar, you follow the commodities market. What kind of stood out in today's session?
Well, I think sterling really stood out in terms of the currency markets. It had been selling off repeatedly in recent sessions and today got a nice bounce. But I think what really will grab the headlines is oil. Oil prices closed today. When I left my office, it was around $77. And so we broke a big technical resistance level just over 76. So it looks like we're on our way to $80 a barrel oil.
We've been up, what, 5-6 days in a row here?
Yeah, volatility in a lot of the commodity markets has really accelerated in recent days. You've gotten some good data. Economic demand is feeling a little better for commodities. Risk appetite is feeling a little bit better, and the dollar's weak, and all those things are getting one big trade going.
How much of it is the weak dollar? I mean, is that a major concern? Is that one of the reasons that you see right now the oil price moving the way it is?
Absolutely. The correlation between euro dollar and crude oil prices this year, just year to date, has been around 91%. So they're very much one of the same trade, and that is just global risk appetite improving, and that leads people to buy commodities, but it also leads them to get rid of U.S. safe haven assets.
Well, fundamentally, though, where should oil be? I mean, we constantly talk about how much supply is really out there, despite what you see from those weekly variations. I mean, there's a ton of supply.
Well, it's a little messier than that. There is a lot of supply in some of the refined oil products right now, distillates, heating oil, diesel fuel. But if you look globally across markets, it isn't as extreme as that one part of the market would suggest. And I do think demand is increasing. I think it will surprise us on the upside, and it'll be able to take up that supply pretty quickly.
So, but wait, when we talk about all the oil that's been stored out in tankers, I mean, what should investors take away from that?
Well, that is part of the market.
Right.
It's there, and I think it is one factor that's going to limit the rise in oil prices, but it's just one part of the market, and in and of itself, I don't think it's enough to bring down the price of oil. But I totally hear you. It's very striking when you fly over Singapore and you just see hundreds and hundreds of ships.
The contango trade's still on then, but this is the level pretty much that we were waiting for, that the people holding that oil and tankers were waiting for, right? Because they put it there at $33, $35 a barrel.
Mm-hmm. No, absolutely. We're getting into an interesting area now with oil because there were a lot of projects canceled and delayed last year because prices dropped too low. Back into the high 70s, $80 a barrel, some of those projects become feasible again. But things aren't turned on overnight, so supply isn't going to come back overnight from that. And in addition to that, even if the prices make things profitable,
gotta have demand there too.
Well, you have to have demand. You also have to have financing. Mm-hmm. A lot of these projects were canceled because the banks weren't willing to give them the money they needed to keep things going.
Is there any reason to be a seller in terms of the markets that you cover, the commodities market and so on?
Well, some of them, the levels have gotten extended, and some of the commodities, gold in particular, ETF positions have gotten very crowded. So there could be a little profit taking, but every time you see any dip, people are very happy to come in and take it. There's still a wall of cash. I know it's becoming a cliche, but there really is. If you look at AMG mutual fund data, anecdotally talking to clients, and they want to get back in the market. They're tiptoeing back in, and when they see a better level to get in, they take it. So I think I agree with your commentary that this is something that is likely to have some legs to it, at least for a few more quarters.
What are the hard commodities that you're finding the most popular with investors who want to get rid of dollars and put them into something that maybe won't lose so much value?
Well, we're trying to focus on commodities that have supply constraints. Demand is a rising tide lifting all boats right now, but you want to focus on commodities where there's shortages of supply either today or hopefully in the future. So if demand falters, you have another price support. We've focused on oil, but we've been in that since 35, which was nice. We've been in gold. We've been in agriculture since April, and the prices there still look relatively attractive. In the metals space beyond gold, we've looked mainly at copper and platinum. Again, we like them still. Fundamentally, we see more upside, but at these levels, you have to be a little bit more cautious, a little bit more tactical about locking in some of that profit.
You talk about fundamentally, I mean, but we also talk about, some of the fundamentals when it comes to the global economy. I mean, there's still a lot of weakness out there. I mean, how does that play into, kind of your thinking here? Are you just saying you're thinking longer term, things are going to get back to normal, it's going to be okay here?
Well, you guys know this as well as anybody. It's always the surprises that move the market. It's relative. The global economy isn't strong by any means, but compared to consensus and compared to where we've been, it's a heck of a lot better. And we think that the surprises are likely to be on the upside in terms of both U.S. and global growth. Again, at least for the next few quarters. So I think demand is going to help fuel this rally still.
Talking a lot about earnings, I'm just curious how much of the equity trade and the earnings that are coming out that you're watching as well.
Oh, it all ties in together. Again, since March, really, we've seen one big reflation trade. Global sentiment improving gets people to sell their T-bills, get back into the debt markets, and increasingly slowly into the equity markets. So the earnings just continues that trend. And how that plays through to commodities and currencies is if I'm getting rid of my T-bill, making me 16, 20 basis point, I want to buy something that has a higher yield or a higher return. And that's equities, it's commodities, it's foreign currencies and bonds. So it's all part of the same big trade right now.
Can you actually predict from the commodities trade what you're going to see going forward in corporate in earnings? Because you obviously need more copper to build more of product X. You need more nickel to build more of product Y. I mean, does it all tie together that closely?
I don't know if you could really use commodities as a good predictor for corporate earnings. What I think you're probably better off watching right now are some of the indicators out of emerging Asia. Are you seeing semiconductor orders going up? Are you seeing new orders for exports out of Taiwan, out of Korea, out of Singapore? Those things tend to give us a couple-month lead of the demand we're going to see out of the U.S., and that ties into the earnings quite well.
You know, let's also go back to Peter Cook talked about the report from D.C. that Treasury saying China's not manipulating its currency. You're smiling. How come?
Well, because you called it breaking news. I think you're stretching the envelope a little bit on that one. But we haven't called a manipulator for some time. I would be shocked. It would be breaking news if we did. You know, the U.S. and China have an uneasy marriage. We need them to buy our treasuries. They need us to leave them alone and not throw trade sanctions on them. So this is just a cat and mouse game that'll continue.
Why are we, though, officially coming out? I mean, we were talking about, you know, Tim Geithner had come out when he just started, took over the position, and talked about them being a manipulator, and then quickly retracted that. So why officially are we kind of making this statement here, in your view?
Well,
why do we bother? I mean, if everybody,
Yeah,
it's never going to happen.
No. It is actually a legal issue. We have agreed that we're going to have this report twice a year, and Congress has asked for it because Congress wants to protect their voters, make sure we have a fair playing field in terms of U.S.-Chinese trade relationships. So the report will keep coming, and behind the scenes, the U.S. will keep encouraging China to have a more flexible exchange rate, and the U.S. will in turn reassure China that we'll protect the value of their billions and billions of dollars of Treasury holdings. So we'll keep sending out the report, and it'll say the same thing most likely, and hopefully China does let their currency slowly strengthen. It is our view that they will.
All right, Peter, you want to join us?
I do. I just want to ask our guest and also make sure you all are aware that this report, at least compared to the last one that we got from Tim Geithner's Treasury Department, is a little bit tougher in terms of language. And I'd love to get our guests a reaction to some of this. In particular, this notion that the Treasury Department has serious concerns about, again, the imbalances in place here, and does believe still that the yuan is undervalued. The language here is tougher. We've got the president heading to China next month. What do you take away from this? Are they trying to make some at least movement here?
A little bit. I think you just answered your own question. The fact that we made that statement right before a trip to China. So usually when we have these bilateral or multilateral meetings, you get the U.S. kind of poking China and China poking back, and we do that to try to get a little progress on both sides. But I don't think it means any sudden shift in rhetoric or trade sanctions or Chinese currency movement is about to happen. That said, right now the market prices in that the renminbi is going to be basically flat for the next 2 years. And I think with China's economy continuing to improve, that the more likely scenario is that you do get some appreciation, not, you know, a rocket rise, but 3 or 4% against the dollar a year for the next few years. So I think there is an investment opportunity there.
Could the argument be made that it really is in China's best interests to let the yuan appreciate, or is that just hopeful?
No, absolutely, it's in their interest. And they've been very public saying that they want this to happen. The problem for us Americans is that we like things to happen now, and China doesn't necessarily approach things the same way. They want a slow to steady appreciation of the renminbi, something that slowly rebalances the economy away from exports, more towards domestic demand, but in such a way that it's not disruptive for their local economy. So it will happen, but it won't happen nearly as fast as most folks in the United States would like.
All right. Rebecca, thanks very much for that. Rebecca Patterson
Thank you.
from JPMorgan Private Bank.